with the work we've done here at Piper Sandler for a long time, we keep track of all these industry groups. So we got over 400 industry groups. One of the ones that I've got is special purpose acquisition corps groups, right? And I just want to have people really understand what has been the long-term trend going all the way back to 2005 when I started creating this group. The trend has clearly been lower. Also note when you've had your best relative performance and strength in some of these groups, right? They were the best strength as you sort of came up into some of these sort of tops and some of these other periods. You got a huge move in these SPACs. I appreciate we're making educated, bets with a lot of these SPACs, but I'm not touching them personally.
You wouldn't touch anything. You wouldn't touch a Starboard SPAC pre-merger.
I wouldn't touch a SPAC at this point in time. I think there's too many other great companies, too many other great momentum names to go play. And honestly, when I have seen SPACs really work, it's been more at the end of an advance in the market versus the early days from my perspective. And this is just not a space that I'm going to get that excited about and lead a lot of the institutional investors into at this point.
What does that mean for the overall market then? Because you just said that, this usually when these SPACs get hot, it's the end of the market advance. So the SPACs are as hot as they've been in a long time. Does that mean we're coming in towards the end of this market advance?
Well, this is where I come into the big picture here and I talk about hope versus reality, okay? And this has been an amazing advance coming off of these March lows. And let me zoom into this so you can see this. But every one of your listeners should understand this. The rally off the March lows has been phenomenal. How phenomenal? 65% in 180 trading days. The only other period that has been comparable was coming out of the Great Depression low in 1933, when you went sort of a rise over run rate of 85% over 180-day period of time. Okay, this is where I look at this market. We put a lot of good news into this. But, Joel, if you want to hear me being a little bit nervous, I'm nervous here in the short term. Let me tell you why I'm nervous. I got a 42.25 year-end objective, but this year is probably going to look like a horseshoe, something along those lines, because the setup right now, I've got the AAII numbers at extreme readings. I've also have got the put-call ratio at extreme historical readings at this point in time. I'd also make the observation that we've been trading at a 17% premium above our 200-day moving average on the S&P 500. And since 1928, we've only done that 3.5% of all trading days. So if I come back and I show you a nice graphical example of this, take a look at this chart right here.
Wait, Craig, grab your screen back. I took it off for a second.
Take a look at this chart right here. I assume you can see that now?
Yep. What do you got?
So what I wanted to show you is when I go back and I look through history, whenever we've sort of traded this far above a 200-day moving average on the S&P 500, we haven't been there for very long. And we've rarely traded 20% above our 200-day moving average. Guys, there is no question this was an absolutely amazing breadth thrust off the lows. Probably the fifth best breadth thrust that I have seen. And the reason why we were so bullish in March and why we thought we'd ultimately trade back above this sort of 90% participation rate with all of the internal data and stuff that we've been calculating here at Piper. Okay. But we've done that already. And we've had this awesome advance, but all the sentiment indicators that we look at are all stretched. And again, I don't want to be the guy that, party's rocking and rolling. And I'm like, hey, could you turn down the music? But the reality is when you start putting the mosaic of all these pictures together, huge advance, sentiment levels well ahead of themselves. And let me also well above your S&P 500 historical above your 200-day moving average. If we also take this and go back to the Russell, in the history of the Russell Index since 1979, we have never been further above a 200-day moving average than we are right now. The last two times we were there, that was in 1983 before a 25% correction. And then also on March 9th of 2000, that date rings a bell to anybody. So what I'm saying is party's rocking. Everything's going great. People are buying SPACs, which are more speculative. And we're seeing a lot of anecdotal evidence of people, going out and telling me what I should be buying with stocks at this point in time, whenever you show up at a local store or a fitness club or anything else. So when the advice starts flipping the other way around, I start getting kind of nervous. And I'm kind of there, Joel, to be honest.
Okay. All right. Craig Johnson, Managing Director, Technical Market Strategist at Piper Sandler. Just going back to that last graph that you have up here, with the yellows, and I'm looking at the time period here. So we could stay at this level, for quite some time. From your work and your studies, how long? What's the typical period that you stay at these extended extremes before you get an actual turn in the market?
So in terms of market breadth, you can be there. A median is 5.5 weeks. The average has been 11. You're around 7 and change weeks now. But the point I want to make to everybody is look at these sort of corrections. If I look back to the last 4 sort of major breadth thrusts since 87, 3 out of the 4 have been reconciled in some sort of price correction. 1 was reconciled in terms of time. So if I have to be the betting individual for all of you and everybody here on the show this morning is, I would think that we're going to sort of get through the rest of this year. Probably not a lot of volatility right now, but then hope versus reality starts to set in. I mean, we baked in a lot of good news about the reopening, the coronavirus, everything else, but I think you're going to have an interesting start to 2021. And I just remind people that in a new presidential cycle, which is starting in January, typically January is flat. February is the weakest month of the year. So I'm expecting some further volatility ahead. And I got to tell you, from talking to a lot of portfolio managers around the world since this last publication came out, pretty much everybody's like, yeah, I just don't want to do anything from here to year end. So I think it's going to be interesting. And then I want to remind people that 1933 was a great advance. 34, really tough start to the year. And I'm sort of looking at how overextended we are right now and saying we can get to 42.25 by year end, but we're not going to get there in a straight line. We are going to see some backing and filling and some sort of retracement of some of this advance. And that's where I think the hope versus reality starts to come into play.